panel tenemos de moderador al señor Carlos Ramírez, expresidente de AIOS y expresidente de IOPS, socio y codirector de Integralia Consultores. Adelante, don Carlos.
Buenas tardes. Good afternoon, everyone. Fantastic to be here again, seeing old friends, and thank you for inviting me and participating in this very important event in Costa Rica. We have a fantastic panel this afternoon. I know we're coming from lunch, but I'm sure that is going to be a very interesting panel, particularly because, as we heard in the morning, the topic of life cycle investments and target date funds is something that is relevant right now, particularly in the Latin American space, but I'm sure that is relevant for all of us. So let me introduce our speakers, Mrs. Dinar Sukmasari. She is the Director of the Pension Fund Supervision from the Financial Services Authority of Indonesia. Welcome, Dinar. Daniel Dersavic, he is the Institutional Business Development Manager from Vanguard. Welcome, Daniel. And finally, Mr. Eric Chang, who is the Executive Director of the Mandatory Provident Fund Authority from Hong Kong, China. So each one of the presenters will provide a very short introduction, 7 minutes each, to frame the discussion, and then we'll move to the discussion. So let us start with, please, with Dinar.
Good afternoon, everyone. Thank you for the opportunity. Since I only have 7 minutes, so I just go right into it. Before I explain regarding the life cycle fund in Indonesia, let me give you context regarding Indonesia pension system. Indonesia pension system consists of mandatory programs and voluntary programs. Mandatory programs are managed by 3 institutions. All of them were founded by the government or the law, and they are regulated by the government. For the voluntary pension programs in Indonesia, we have employer pension funds who manage DB plan or DC plan, and the financial institution pension fund, or we maybe know it as open pension fund. For open pension fund, they only manage DC plan. For the voluntary pension funds in Indonesia, they are regulated and supervised by the Indonesia FSA, or we call it OJK. So there are 2 different regulators here for the mandatory and for the voluntary program. For mandatory programs in Indonesia, we do not have the life cycle fund yet or targeted date fund yet, but for the voluntary pension program, we introduced the life cycle fund in 2017, but only for the DC fund for the employer pension fund. It is mandatory in Indonesia that for employer pension fund, that manage the defined contribution funds to implement the life cycle fund or targeted fund, where they have to manage using different strategy to invest during several SIM or several periods depending on the pension age of the participants. Whereas for the financial institution pension fund, we only recommend the life cycle fund, so the administrator or the provider of the open pension fund only offer to the participants, but the participants could choose that they do not have the life cycle fund, and they choose the more traditional funds like the equity fund, fixed income fund, or mixed fund. So these are the difference between the employer pension fund and the FIPF fund for the implementation of life cycle fund. So how the life cycle fund in Indonesia works is actually triggered by the two dates. One is the pre-pension age date and the pension age date. For the fund, we manage them with three phases of the operation of the fund, of the investment of pension fund. The first phase is the accumulation phase, and the second phase is the pre-pension age phase, and the last phase is the payment phase. For the first phase or the accumulation phase, pension fund in Indonesia could set their own asset allocation, but still under the limitation of the law or the regulations, such as they still have to put the investment in government bond, minimum 30% of the investment, and the rest of the funds can be put in various instruments such as stocks, bonds, asset-backed securities, mutual funds, even properties. And the limitation of the investment of these funds are actually very flexible. With the exemption of the government bond and the property, we limit the maximum up to 20% and the direct investment up to 15%. Those funds are for the accumulation phase. But once the fund or the participant enter 5 years before the pension age or the latest 2 years before the pension age, then the strategy of the investment should be moved into more stable funds and more stable instruments, which are government bond, central bank securities, or the money market instruments. The same instruments can be chosen while in the third phase of the fund or the payment fund. So the choice of the instruments will be the same for the second phase and the third phase of the investment period. So what are the challenges in Indonesia regarding the life cycle fund? Here I see these challenges into three main challenges. The first one is from the participant point of view. Somehow in Indonesia, the knowledge and the understanding regarding life cycle fund or target date fund and the benefit for especially for the DC participants are still relatively low. So when the administrator of the open pension fund offered the life cycle fund to the participants, at least until now, none of the participants chose the life cycle fund. The second challenge is that from the pension fund itself, that the difficulty or the complexity to operate on the life cycle fund are not something that every pension fund in Indonesia could manage well. They may have the human resources challenges and the infrastructure challenges because the life cycle fund are managed in more sophisticated way than the normal or regular investment strategy. And the last challenge is more from the environment or the ecosystem of the financial system, especially for the financial markets in Indonesia, because until now, there are still very limitation of the instruments that can be used by the pension fund administrator to match the liability of pension funds. Thank you.
Thank you, Dinar. Eric, would you mind to follow, please?
Please show the slides on. But before that, I would like to thank to Supan for the hospitality and the opportunity to share our experiences in implementing a life cycle strategy in Hong Kong. And a very quick overview of a context. In Hong Kong, we have this mandatory provident fund schemes, and it is a Pillar 2 system, and it complements other pillars of retirement protection vehicles. What I want to highlight is that we have over 4 million scheme members, and so that means there would be a great variety in terms of their financial literacy, and that frames the context why we need this DIS, a default investment strategy. And another thing to point out is that we have 12 trustees running 24 schemes, and our employers are responsible for selecting the scheme to enroll the members in, but the members are responsible for doing their own investment choices, which we call funds. And so before 2017, we did not have a standardized default arrangement. So each fund, each scheme would provide its own default. So some scheme may just put scheme members' money into money market funds, which are low risk, if the scheme member did not make any choices. And at the same time, we did have some target date funds introduced in around 4 schemes, 20 funds, but it's not widely available. So according to OECD principle, we really need to develop a well-designed default choices for our scheme members. At the same time, we may be able to implement it through a life cycle strategy. So we killed 2 birds with 1 stone. And the policy drivers really, because we have many scheme members who complain that, oh, there are many funds in our system, but I don't know how to choose. And so I just don't know what to do, and I randomly select some, which is not good for the retirement protection outcome. And some other members also complain about fees levels. And that drove us to design a default investment strategy so as to cater for scheme members who may who think that they don't have the financial literacy to do the choices, or they don't have the time to do the choices, or those who just don't bother. And at the same time, we try to tack on the issue of fee control. And a little bit about our policy framework. So we introduced this default investment strategy through legislation. So each scheme would be mandated to provide this strategy. And we chose a life cycle strategy in order to implement this investment option. And if the scheme member does not give any investment choice, the money would automatically go into this DIS. But at the same time, the scheme member would have the option to opt out. And we very much emphasize that this DIS has a dual role. Apart from a default, it also functions as an available choice. So scheme members are really welcome to consider the merits of this fund and actively put their money into this strategy. So here is a nutshell of how this DIS functions. So 3 major features. First thing is that you can see on the panel on the top left corner, you will see 2 acronyms. One is CAF, one is A65F. Basically, they refer to Core Accumulation Fund and Age 65 Fund. So we implement this life cycle strategy through just 2 funds. And the first fund, Core Accumulation Fund, is a main vehicle. And most of the time, the scheme members' exposure will be entirely in this fund and consists of 60% of high-risk assets, which are mainly global equities. And another 40% goes to lower-risk assets, which are mainly global bonds. And the other fund, Age 65 Fund, is the vehicle we use how to gradually de-risk the portfolio for each individual scheme member. And it consists of 80% of lower risk assets. So on the panel on the top, on the lower left, you can see this automatic de-risking mechanism. And here is how it works. Once the scheme members hit the age 50, and then we would ask the trustees to automatically convert a certain percentage of the exposure from CAF to A65. So after 15 conversions at the age of 64, the entire portfolio would become like A65, entirely exposure to that. And so through this way, we shift the exposure and manage the risk for the individual scheme member. And one last tag-on feature is the fee caps, and we apply this fee cap to the 2 DIS funds. And even though we don't have fee caps across the entire system, but we envisage that the fee caps in this DIS would serve a benchmarking effect on all other funds. So a quick overview of how this DIS is performing. It has consistently experienced growth, and we want to highlight that after almost 10 years of development. Right now, in every 10 MPF accounts, we have 3 accounts with exposure to DIS, and it right now accounts for 10% of our AUM. This one shows some very interesting statistics. So on the left, you will see that among all age groups, the exposure to DIS by account number would be highest, significantly highest in the younger cohort. So this proves that the default arrangement should be at work, because these are the scheme members who may have joined in the system in the past 10 years. So they will have run through this default arrangement, whereas the older generations would only go through this procedure if they change jobs. And another interesting statistics is about casual labor. We have a specific scheme called industry schemes, and they're catered for daily wage laborers. And these are exactly the people who would not have time to manage their own investments. And so we can see that 20% of these people would go into default, which is double the figure of an ordinary scheme member. Quick overview of the performance, and the performance has really beating our expectation, and the CAF, the main vehicle, has registered annualized return of 6%. And at the same time, because we use this as a vehicle to drive down fees across the system, so we can see that in the category of all mixed asset funds, we saw a 41 basis point reduction in the average fee level, or 24%. And even though in our law, the fee cap is 95 basis point, but actually, because of competition, the actual fee level right now is 77 BPS, which is among the lowest across all fund types. So challenges ahead. One thing that we recently really discovered in our internal review is that DIS has dual role. It's not just default. We would like to imagine that the invisible hand plays a very strong hand, but in reality, it's also important to look at whether scheme members would choose this life cycle strategy by active choice. The reason is if scheme members fall into default only by disengagement, then over time, maybe they will be persuaded by some distributors to convert their funds out from the DIS, and then the whole merits of the automatic de-risking would be derailed. And so it's important, even though we attract some scheme members by default, but over the course of their life, we need to educate these scheme members in order to convince them of the benefit of staying in DIS. And we witnessed that our efforts have paid off. In recent years, when we see the numbers, and more scheme members are coming into DIS accounts through active choice rather than by default. And one thing we want to highlight is that we're going through a digitalization effort. And after that, we will have unique member data, and we will look at the big data to see the behaviors. So this is pretty much what we are doing, and we really look forward to the big data being making available by the MPF platform, so that we can even improve the DIS better. Thank you.
Thank you, Eric. Your turn, Daniel.
While we wait for the slides, hello everyone, and thank you in Vanguard's name for having me today. My name is Daniel Dersavich, and I am a business development manager at Vanguard, responsible for our firm's clients' coverage in Central and South America. Did you know that asset allocation explains over 90% of a portfolio's return variation? That's why getting it right in TDFs is critical. Today, I'll share Vanguard's perspective on what works in target date funds and why. Before I begin, I do want to briefly touch on a summary of why, in my view, we have the right credentials for doing so. Vanguard is the #1 manager in TDF AUMs in the US, with over 15 million investors entrusting us with more than $1 trillion in TDF assets. Vanguard retirement funds, on average, have performed in the top quartile among their peer group for 10-year returns. Having said that, there are two main aspects that we think can help us explain the success of TDF implementation. Let me get the, Firstly, I would like to talk about aligned interests and how this has a direct impact on the success of our TDF platform. Unlike many asset managers, Vanguard doesn't have outside shareholders demanding profits. Instead, we're owned by our funds, which means that our investors, your participants, benefit directly. This structure allows us to lower costs as assets grow, reinforcing our alignment with investor outcomes. The success of our participants is the success of our company. The second main aspect that can make TDF adoption successful is a well-designed glide path that supports long-term outcomes. We design our TDFs to help the greatest number of participants successfully reach their retirement goals. Our glide path optimizes asset allocation to balance risk and reward along their journey. Thinking about design, the first thing we must discuss is purpose. Our TDFs are not made to maximize returns. If that were the focus, it could expose participants to severe market downturns. They're not about minimizing risk either. If we did that, we could create longevity risk for our participants. Our TDFs are about generating sustainable and reliable income for the participants throughout retirement. With this purpose in mind, we can say that a balance of growth and capital preservation is crucial. According to our research, and as I stated at the beginning, asset allocation is the best predictor of performance in a portfolio, accounting for 91.1% of the portfolio's movements. A glide path, as shown here, isn't just about shifting from stocks to bonds. It's about ensuring that participants don't take too much risk when they can't afford it, but also don't get too conservative too early, which could lead to running out of money. This will help them sustain income through retirement. I want to direct your attention to phase 3, the target date. This is crucial because it's the bridge between accumulation and retirement income. We have seen cases where investors who self-manage their portfolios make mistakes. For example, someone who shifts to 100% bonds in their early 60s may struggle with inflation risk over a 30-year retirement. TDFs can maintain the balance. How do we make sure that investor outcomes are able to improve? Number one, inputs. They must be comprehensive. We combine participant population characteristics with our proprietary Vanguard Capital Markets Model asset class forecasts, comprised of distributions of expected returns, volatilities, and correlations, to evaluate potential downside risks, various risk-return trade-offs, and the diversification benefits of various asset classes. 2, the glide path is constantly evaluated. Due diligence is done through constant analysis of existing glide path against thousands of simulated glide paths using our Vanguard Life Cycle Investing model. Number 3, our glide path is designed for the real world. Glide paths are not static. Practical considerations and observed participant behavior are considered to meet the needs of real-world TDF investors. For instance, changes in life expectancy or withdrawal patterns may lead us to adjust risk exposure in later stages. And number 4, helping improve investor outcomes. We focus on meeting the long-term goals of wealth accumulation, balancing portfolio volatility, and maximizing drawdown ability to ensure a high likelihood of meeting the retirement income sufficiency needs of our investors. At Vanguard, we've spent many years refining our TDF approach on data and investor behavior. I'd love to hear your thoughts. What challenges do you see in implementing TDFs in your markets? Let's discuss. Thank you.
Thank you, Daniel. Very interesting experiences in the 3 countries. Daniel, by the way, in Vanguard had a strong participation in the Mexican reform of 2019, in which basically Mexico switched to a target date funds. I was not the guy that operated that change, but we left some path already done there. And so I would be very interested in listening to the experiences of the 3. But let me ask you the same question to each one of you, and obviously move from there to other very specific issues. So Indonesia, Hong Kong, and Mexico basically switched to target date funds or investment funds around the same time, 2017 or 2019. So the question for you is, has it been worth it? I mean, you obviously in some way or another explained or expressed some of the issues that has been going on, but is it really worth it? Some countries are thinking about switching from a certain strategy, but is it worth doing all this work? Can you please provide us with a view on that, and certainly here also Hong Kong and Mexico, please?
Okay. Well, since I'm from the supervision, I have various aspects that need to look at. For instance, like from the point of view of the pension fund itself, of course, it's a good investment strategy because they tend to adjust the choice of instruments in accordance to the liability period or the asset liability management. But particularly, that benefit most from the life cycle fund in Indonesia, I think, is the participants. Because before the life cycle fund, every DC participant was exposed by the market risks. Even like if they are going to have the retirement date next month, today they have a huge amount, like for instance, like 1 billion rupiah. But since the market declines, then they could get the pension benefit only 75% of the previous month, something like that. So the exposure is very high for the participants if the manager of the pension fund do not differentiate the strategy of investment between the young participants and the almost pension participants. So the biggest benefit, I believe, is for the participants.
Okay. Hong Kong?
It's certainly worth it, but we're fortunate that we did not have to do the conversion previously. Prior to 2017, we had a system that each trustee would be free to provide a fund range, and it was not compulsory to provide target date fund. And the change we made is that it became mandatory to provide life cycle investment strategies through this DIS. And of course, it involves some work because now every scheme has to provide it. But the immediate change is that before that, only 4 schemes provide life cycle strategy. But now, all 24 schemes would make it available. But on top of that, we achieve additional policy objectives. For example, as I mentioned, previously the default arrangement was not well designed. Some schemes put money without investment mandate into a money market fund, which dragged down the system return. Also, because we apply this fee cap to the DIS, so we help to lower the overall system FER. On top of that, we have this benchmarking effect. So because of competition from these DIS, all the other funds also went through fee reduction. But last but not least, through DIS, we help to reset the diversification or risk profile of the entire portfolio of the system. Because when you gave the scheme members the choice, inevitably there would be some home bias, because not all scheme members would have this financial literacy. But when we build this portfolio for DIS, we follow the orthodox financial theory. And so when scheme members who do not know how to choose or don't have time to manage, they automatically go into this portfolio. And so through this way, we set the whole balance in the system. So with so many policy objectives achieved, that we find it's really worthy to push through this reform.
Interesting. Daniel, what do you think about the Mexican reform and your experience there?
I think, I mean, answering your question directly, Carlos, it is worth it, but I think it's important to mention that it's not the solution. It's part of the solution. Now, we would need to focus first on increasing savings rates, right? I mean, that's an important part of the equation, and that's what truly matters. But thinking about TDFs in particular, I think it does help in many instances. For example, it avoids funds making timing mistakes. You have the glide path, and instead of reacting emotionally to market fluctuations, you have your asset allocation, and you can trust the process. Also, the asset allocation, right? You set it from the beginning. It's what matters, as I stated in my presentation, and you stick to it. So you make sure that the process works and that the outcomes for the participants are the best. Another feature that's very important, and we've spent a lot of time at Vanguard thinking about it, is automation. It gives you a way to make sure that people are in the system, they're saving. It gives you opportunities also to enroll them in auto escalation. So I think those things are important. And I think, I would think those are the main benefits that I can think about, so that it is worth the transition to targeted funds.
Okay, so in trying to bring your ideas together, I mean, you force the funds to think in the long term, right? Because there's some tendency for short termism, and now with targeted funds or investment funds, default investment funds, it forces managers to think in the long term. It has brought more competition into the system. In some way, it has brought down fees. Obviously, it is for participants that do not get involved too directly, it is a very nice solution in the sense that you help them through a glide path move without, with less risk. So, sounds great. Now, what are the challenges probably that, if you would be again in 2017 or 2019 in the case of Mexico, and Daniel, probably you could explain a little bit more on how Mexico has its target date funds. What would you change or not repeat from the 17 experience, right? What would you do different in your experience? So probably, Daniel, if you would like to start there.
Sure. I think one thing that we hear a lot from regarding challenges is when the transition was taking place, there wasn't enough flexibility to keep the portfolios well flexible. So when the actual movement went through, some of the portfolios were concentrated in vehicles or in products that maybe they shouldn't at that point. So there was this part of it was a moment where for portfolio managers it got a little bit complicated. Then I think another of the learnings is that as much planning as can be done is crucial, right? We hear that it's hard to plan for something that you don't know, but as close as you can work with regulators, as close as you can be with external advisors, that also helps. Yeah.
Okay. How about Indonesia?
I think education. If I could go back to prior to 2017, I would say that it would be better off if we had more campaign, more education for the participants regarding the investment strategy, regarding the life cycle fund, target date fund, and at the same time have the better skilled administrator or pension fund managers for this fund, because when I mentioned that this is mandatory for the employer pension fund, it means that they manage for their own for the employees of their founders, something like that. What happened in Indonesia is usually the administrators or the managers of the employer pension funds are also part of the employer itself. So they have two jobs at the same time, and they maybe don't have enough focus for the pension fund. So for certain pension funds to manage this life cycle fund, this become very challenging because they do not have the resources, they do not have the infrastructure and even the focus. So I would say that if I could go back years before, then the preparation for the pension fund itself is also very crucial.
And what would you say from a supervisory point of view? What would you say? I mean, how has that been going on in Indonesia, the supervision? Challenging or difficult? I mean,
Of course, because let's say we compare DB and DC, because DB we do not ask to have the life cycle fund because the risk borne by the employer. But for the DC, we have to really check the operational risks regarding how the rebalancing are done, and how the fund managers really implement the life cycle fund for every participant, not just in the aggregate way for every fund. So for the supervisors, of course, there will be more challenge in make sure that every DC, every employer pension fund DC implement the life cycle fund in the exact manner, for instance, because we need to sample whether 5 years before the pension age of this certain participant, the strategy really shifts into the more stable instruments or not. We do not have to do that for this DB plan, so that would be one of the challenges for the supervisors.
Okay. Eric.
Thanks. I would have 2 points of reflection. First one is also about education, but with a different twist. As I emphasized in my starting presentation, there is a limitation to the functionality of default or opt-out mechanism with hindsight. I mean, if you were at the time point of 2017 with everything starting from scratch, you'd be very tempting to be persuaded by theory of nudging. I mean, it would be convinced by invisible hand. But actually, cultural differences across jurisdictions really matter. In the literature, we may see some jurisdictions with people falling into default investment option by a large margin. For example, as high as 80% or 90%, but not the case in Hong Kong. We, with years of experience, observe that our scheme members tend to take things into their own hands. They are very sensitive to money matters and would not want to leave the decision to somebody else. And so the function of default versus the positioning of this DIS as available choice is actually less important than we originally foresaw. And so with this hindsight or knowledge gained from hindsight, we realize that it's really important to educate scheme members about the merits of the design of DIS so that they can actively choose this investment option. Or even if they fall into this investment option by default in the first place, they will not be lured by the other fund choices in the middle and switch out. And my second takeaway is about the glide path. And if you recall what I presented, our main vehicle, which is the core accumulation fund, has 60% exposure to high risk assets. And so some financial commentators would think that, oh, this is a little bit too conservative, in particular before age 50, and that may limit the upside or the accumulation potential for this strategy. So I would not say I will for sure change it because this number is not picked by random. It was a result of modeling, in particular with the constraints, for example, the withdrawal options available, and we have to operate with the scenario that in case there is a sharp market downturn, a member's outcome at the year of retirement will still be protected. Even so, we would really want to look at the glide path again to see whether there could be some point of improvement. Yeah.
So Daniel, could you reflect on the 60% risky assets at a very early age? What's going on in the US, for example? The target date funds from Vanguard, how much do they have of risk at the very early age?
So what our research has told us is that the optimum starting point is 90%.
90%.
90%. So we've seen cases where they move that number to say 95. But then as I said at the beginning, it's not about maximizing profits. It's about making sure that the participants have enough money through retirement.
Okay, so and by the time they arrive to 50, what is the risk profile, I mean, in terms of the asset allocation?
So as I showed on the glide path, the idea is that it's gradually, the equity part gradually decreases up until you get to the accumulation phase.
Okay.
And after that, there are options, and we've seen that it's hard for participants to decide what to do at that point because you have all this money that you've been saving, and you have to make this decision, which is complicated, to convert it to an annuity, for example, or just to get like the bulk sum. It's not easy. Okay. One of our recent research pieces is about actually hybrid TDFs with annuities. And we think that's something that mixing both worlds together can be very productive and very positive for our participants.
Okay. Dinar, the accumulation phase in Indonesia, I was wondering how does it operate with the default investment funds? Where do you land when you're 65?
Well, as mentioned earlier, that the latest 2 years before the pension age and in Indonesia is 65. So when you ask me where the money at the age of 65, it would be mainly fixed income and some of the money market instruments because we only allow them to have the government bond, the central bank securities, which is also fixed income, and the money market.
Okay, but you turn 65, right? And at that moment, you can retire.
55.
55?
Yes.
Okay.
So in 95, we already become the pensioner.
Okay, 55. Okay, so
65,
and at 55, you choose an annuity immediately, or what do you do there?
In Indonesia, there are two options. Not really an option, actually. If the monthly pension benefit below a certain amount, they can get the total in a lump sum. But if it's above the certain amount, then they should be paid in annuity, either by buying the annuity from the life insurance company or directly paid by the pension fund.
Okay. Eric, Could you speak a little bit more about how you constructed the glide path? You mentioned that you worked with the OECD, and how did that go? Could you give us some ideas there?
So it also relates back to the withdrawal option, not option, actually, the accumulation structure right now. The main constraint in the modeling is that our system allows withdrawal, lump sum withdrawal at the age of 65. And so on that basis, we have to model if there's a sharp market correction at the age of retirement, which is age 65, then the retirement outcome will still be maximized through this guide path. And we need to do a Monte Carlo simulation, so many different scenarios, different parameters about performance of the stock market, inflation rate, blah, blah, blah. And so we arrived at this asset mix. So both the asset mix and the starting age of the glide path.
So at 65, you can take your money out in a lump sum.
Yeah, that's a legacy issue because before our mandatory system came into place, we already has this occupational retirement scheme, which is voluntary, and that's people's expectation.
Okay.
And so we can only work from there to encourage people to stay in the system longer or face withdrawal, program withdrawal.
So all the work you did for the past 40 years, at the 65, someone can just take out the money and absorb all the risk after they retire.
Yes, at the moment, but the government has also rolled out public annuity plans, so scheme members may choose to take this lump sum withdrawal to pay off a whole life annuity, so as to manage longevity risk. And we are also thinking about how to develop retirement income strategy in the sense that actually we think that with the longevity growth, the accumulation phase has to be extended. So if some scheme members would like to make use of our system to continue these savings, so they can stay in our system for longer and start to decumulate later, and perhaps with some other fund-based retirement solutions with regular distributions, so they can manage inflation risk and longevity risk in one go.
Okay. I was looking at the data you showed. You have 10% of assets already in the default, in the Ds, right? Default investment strategy. So, I mean, it's fairly good. I mean, obviously the growth rate has been quite impressive, but still remains 10%. Why is that? Why haven't more people moved to the default investment strategy?
This is a good question because even though we think that it's an achievement to hit the 10% mark, but we would want to see the share much higher, because if this share were higher, then our overall system return and the system would be much better, and our system fee would be even lower. And back to your question about why is that, one is what I come back is that in our jurisdiction, the culture is that people like to take things into their own hands. So when we construct this whole DIIS package with default, we originally would count on default to play its role. As I pointed out, it did play a certain role to younger scheme members and to those daily laborers. But even these people tend to make choices. So if you don't have this default rate more than 50%, which means that the growth in exposure to DIS would be constrained somehow. And another interesting issue is that even though some people are convinced by the merits of DIS, they still tend to have this amateurish habit to construct their portfolio, not really by any theory, but rather to like throw the darts on the board, and so they have a bit of everything. So, for example, so you mentioned, I'm a scheme member, I'm convinced by DIS, but let's say I put 25% on DIS, and then maybe 25% in China equities, 25% in North American equities, and 25% in bond, and it's a random portfolio being generated, and that constrains to the growth or exposure to DIS as well.
Interesting how they operate, I mean, you have these funds and then you have the target date funds, and they, in some way or another, are together, right? So you can switch from one to the other relatively easy.
And the choices are very flexible, so you can mix and match to do your DIY portfolio, which is a strength as well as a constraint.
Okay. So, Daniel, I would like to ask you about the experience of Mexico regarding its the limitations of the investment regime, right? So Mexico transitioned to target date funds in 2019, but there was always this limitation in which basically Mexico can only invest 20% of its funds abroad. And that has limitations in terms of how much equity they can have. So could you provide us with some view on that, and how was that challenge fixed? Or
Yeah, it's a very good point, Carlos. I think that some of the measures of that investment regime have been a little bit tight if you think about what you need to do with TDFs. As you know, in many of our countries, the capital markets are not as profound. And so if you want to have a portfolio, a TDF that's investing 90% at the beginning in equities, or say even 70, how can you do that using only local equities, right? You need to open up those regimes so that TDFs work the way they should. I think that would be the message.
yeah, absolutely. And actually in Mexico, the law hasn't changed, so you are still capped at 20% investment abroad, which is certainly something that should change, but hasn't changed, unfortunately. Yeah. But even though that limitation, Mexico was, I would say, and I would like to hear from you, successful in transitioning to target date funds.
Yes, I think the industry has adapted to the constraints, and it can work. It's not optimal, right? I see a lot of discussion around how many cohorts, how many actual funds should they be so that everyone is covered. Then
Mexico has 10, right?
Yeah, it does. But that discussion becomes less important if the regime is not open and you're not able to fill the assets in each of the slots, right?
Okay. Dinar, do you want to reflect on this? I saw your asset mix. You have to be 30% in government bonds. That's a restriction. What about investments abroad?
Currently, the pension funds are not allowed to have the investment abroad. We introduced the investment abroad like around 10 years ago, only for a while, but even during that period, even it was proposed by the pension fund to open the investment limitation so that they could invest abroad. But in reality, even after we introduced the regulation, none of the pension fund invest abroad. It was very interesting for us. But later on, we closed the opportunity, and all the investments now can only be done in Indonesia or locally. The same thing for the mandatory, although currently we're still working on the government regulation to change that. There's been a proposal to open for the foreign investment so that the pension fund, both the mandatory pension fund and the voluntary pension fund, could invest abroad. Although, well, based on the history, we are not so sure if we open the opportunity that the pension fund would invest abroad.
Okay, thank you. Let us go for one more round of final thoughts on your specific experience, and then open the door for some questions from the audience. So let me start with you, Daniel. What are the, and you have a very broad scope on what's going on in the, on this investment strategies, particularly in the US. What are some sort of innovations you are seeing in the target date funds world?
Yeah, I think I would mention three in particular, Carlos. One is enhanced risk management. So given what we've been talking about regarding life expectancy after retirement, it's important to spend time with that, and I think that's something that many plans and many advisors are looking.
How does it work? Could you explain to us?
So it's a matter of just updating your research in terms of longevity, in terms of withdrawal patterns, etc. Another important thing, I mean, integration with technology and AI, something that we've been seeing a lot. And I would say that also personalization. And although at Vanguard we haven't seen a straight case to do a lot of that, and we want to make sure that we're optimizing with costs, etc. There's a trend of trying to personalize TDFs as much as possible. We are, of course, doing a lot of research behind that, but that's also something that's going on.
So artificial intelligence is going to kill the funds,
no,
the managers?
It should give us more tools to design better plans.
Okay, interesting. Thank you. So what about Indonesia? So let's say, Dinar, you are sitting here in 10 years. Where is the system going, and what are the trends that you would like to see in the next coming years?
In the past 10 years, the employer pension funds in Indonesia are declining in terms of the participants and the growth of the funds. So the future of Indonesia pension fund would be the open pension fund, because it would be expensive to have employer pension fund. So the employers would shift the management of the pension fund from the employer pension fund to the open pension fund or FIPF. But as I mentioned earlier, that the life cycle fund or target date funds are not there yet in the FIPF or in the open pension fund. So hopefully 5 years from now or 10 years from now, we would see the implementation of the life cycle fund in the FIPF, because the future is there. Because how the Indonesian people manage the private pension fund would be through the FIPF, not employer pension fund. And since it's voluntary to have the life cycle fund in the FIPF, so it would be really depend on the education, the awareness, and the skill of the administrator or the manager of pension fund to have this implement. So I hope that's what happened in the next 5 years.
So Eric, where would you see the numbers of the default investment strategies in the next coming years? Would you think that number is going to move up? What are the challenges coming for your pension system?
I don't have a crystal ball, so I can't give figures, but I'm quite confident the figures will continue to go up because even nowadays, we only have a decentralized system, so we only have some data with limited quality, but we already see that scheme members who go into a default investment strategy do it by active choice rather than by default, and we think that the education campaign we have been doing are paying off. But looking ahead, for some attendees who may not be familiar with what we're doing, we're actually centralizing scheme administration through this EMPF platform, and which is a public utility for everybody. So we have centralized the data, and by that time point, we will have much better grasp about scheme members' behaviors. So, for example, at the point of enrollment, whether they fall into a DIS by default or by choice, and when they invest in DIS, whether they put all their money into contributions into that, or as what I said, they still throw darts on the board and randomly select something else. And also what we would be very interested in seeing is whether these scheme members who have exposure to DIS would at some point in the accumulation phase switch out. And if so, when, why, we probably have better grasp. And with this platform, we also have a very good tool to have segmented education messaging, reaching out to them. For example, when imagine that a scheme member gives an instruction to switch out, we may immediately give a prompt to them, oh, you are switching out from the DIS, which is going through the automatic de-risking. Are you sure where you want to go on? Or even if you want to go on, please be reminded to manage your own risk exposure. So probably we will be doing much granular or tailored functions for the DIS, and I hope that this will serve our scheme members better.
Great. So we have some minutes left. I don't know if someone would like to ask any question, please. Thank you very much.
Yeah, thank you for the great panel and the very interesting presentations. So I did want to direct a question at Danielle. And I have I'm from the World Bank. I have a U.S. background, so I'm very familiar with the Target Date Fund performance in the U.S. market. I've also seen some really good research by Vanguard that talks about participant behavior, like even just in the wake of the recent pandemic, March 2020 specifically, how they just were that much more sticky as far as in a system, in a DC system where there's participant choice, participants were much less apt to jump on, the worst days of March 2020 than when they were in other investment options. So just a bit of a softball, maybe, Daniel, for you to talk a little bit about that.
Yeah, very good question. Thank you. I think the key message here is that automation works when you rely on people's behavior to do things. Most of the times that you will end up waiting. You need to make sure that as much of the process is automized. And yeah, I think you're referring to a study that says that 90% of participants in TDFs stay invested through market downturns. And if you compare that to participants not in TDFs, I mean, the number is 70%. So it's strong evidence. I don't know if that answers your question.
Please.
Hello, everyone. Thank you for the great presentations. So my question is for Mr. Daniel. Vanguard has many ETFs, so my question is how to direct people to the right ones regarding the diversification, ESG via investing, and also ETF fees. Thank you.
So regarding ETF fees, I think that's an important part of the equation. We mentioned it at the beginning. One of the few things that we can control in the investment world is costs. A small saving today can translate into a huge difference in your outcomes later on. So that's why we make this point of providing with low-cost investments in general. I mean, this is good for our funds, and this is also good for the TDFs that we manage. I didn't quite get the first part of your question. Would you repeat it?
How do you?
Well, that's one of the key benefits of TDFs, right? You don't have to convince anyone of doing anything. It depends on your age. So with your age, you're in the right path. that solves for people trying to do weird things when they're investing for retirement. You're always in where you should be.
So, but if you have the same, let's say you're 35 and you have, I mean, you still have different options of TDFs, right?
You can move for sure, but people won't move.
Okay.
That's what we see. Inertia is important. Momentum is important. People will stick to
the one they
what's
chose.
automatic. Yeah.
Okay. Please, yes, of course. Chile.
Okay, thank you. So thank you all the panel for the presentation, very interesting. I have a question for Mr. Eric Tang. I was amused about what you say that people in Hong Kong don't fall into default so much as in other places, because in Chile is the opposite. And what are your thoughts about that? If what is this only cultural, and also if they make good choices when as they are choosing a lot? As I think I understood.
Yeah, thanks, Ursula, for your question. I can only speculate on the reason, because cultural things are hard to prove. But one thing I observed that is because Hong Kong itself is an international financial center. So in our daily exposure to news, there are constant information about financial news and commentary. There are a lot of columnists giving financial advices. So people are quite accustomed to this type of things, and they also have opportunities to do investments by themselves. So one issue we encounter is that too many scheme members take the pension pot as if they are going into stock market themselves, and they try to do, for example, daily trade, and we don't charge people for switching funds, and we don't have bid-ask spread, and actually some people think that, oh, this is a great way to speculate. And so this is one thing that we try to counter in education, is that pension investment is a long-term investment. It can last for 40 years, and you should not really handle it like stock market speculation. And this is something that we need to do more to educate our scheme members, and we think it's important for them to stay committed to a particular strategy rather than to change their mind once in a while. But you also mentioned that whether they do the right choices, and it's very hard to say, but we do observe that pattern that after a market crash, that usually the columnists, you're not the professional advisors, would only start to make commentaries with time lag. And then scheme members would respond to these amateurish advices on the newspapers with another time lag. And so by the time they make the decision to switch, probably is not the best timing, and instead of really averting the risk, they actually lock in losses. And there may be some evidence when you look at the data, because if you look at the returns through, for example, weighted average of the fund prices, then the return may be higher. But if I calculate the returns through IRR, then I will see that it's lower. Then I suspect that the fund flow actually suffers some losses through these cycles.
Yeah, you don't have to convince us, right, about those guys that advise about moving to different funds. I think we have one more question left.
Yes, thank you very much. It's for the representative of the industry at Vanguard. I would like to have a sense of how different is a glide path for same cohort and different country. I am interested in what you said about regulation in Mexico, for example, how the regime, the investment regime, limits what you can do, and maybe in comparison with US that you mentioned you had instrument there too. Thank you.
Yeah, thank you. I think it's important to take the inputs into account, and the relevant inputs for each region. That's why the solution shouldn't be the same for every country, right? So it depends on life expectancy, it depends on income. There are many variables that need to be taken into account, and that's what makes TDFs across regions different. Yeah. There was another component to the question, I think.
Okay, yeah, do you want to go? Yeah.
Thank you. Yeah, indeed. What you said, it's pretty obvious. I mean, it's the context matters for the glide path you are going to have. But I would like to, if you can go a bit deeper in how the investment regimes affect what you can do in TDF. Why?
Yes,
Because in the region we have different regimes. We, as the two panelists from Hong Kong and Indonesia, for example, showed, when it's very local, or only local investment, open investment, etc. And in Latin America, our reality, it's very wide different also.
Yes.
So if you can give a sense. Why? Because in countries like Chile, for example, we are in the path now to make it more flexible or more easy to understand the regime. In Mexico, as Carlos mentioned before, it's if you see the OECD table with the limits, Mexico is like 5 pages, you see?
Yeah.
And then you have Netherlands, it has very flexible everything. So this is the kind of thing that I would like you to say more pedagogically to the supervisors, how we can have a sense of that in dealing with TDF.
Yeah, I mean, us as managers, we have to work with what we have. What we can do is sharing best practices and sharing what works. If there's an investment regime and it's something that's fixed, then, I mean, we will try to work with it. But our ideal would be that investment regimes become more flexible, so that the actual glide path also goes in the right direction. It's not always easy. There are political aspects. In many cases, we're talking about even constitutional changes that need to take place for that to happen. But we do think that in order to set up a professional portfolio, you need to be able to go to those percentages and those quantitative goals. So yeah, it would be important to work alongside with regulators to make sure that the regimes are a little bit more flexible.
Well, it's been fantastic. Eric, Dinar, Daniel, thank you very much for this opportunity, and thank you very much for listening.